How do you balance diversification versus home run investments? I want to invest into AI trend, but I'm struggling between choosing individual stocks and or the ETFs.
Yeah, okay. That's a good question, actually, because we get that a lot. You want to be, in my opinion, pretty well diversified
Hmm.
because you want to be able to kind of handle all of these things. Really, what you're saying when you're diversifying is you're not positive where things are going to go, which should be true. Not many people, well, have demonstrated that ability to know where things are going to go. So if you kind of own everything or lots of things, then if it goes there, you own it, right? And so let me share my screen because I do have a. We'll use this shot here. There we go. This is the basic model we use.
Yep.
Okay, so there's three big core pieces, right? And those big core pieces are wildly diversified. We will use things like the Vanguard Total Stock Market Index, ETF, which is VTI. That owns almost every single stock in the U.S. We will use maybe the ESG version of that because it does well, or we'll use the S&P 500, or even VT, which is the Vanguard Total World Index. I think it's over 7,000 stocks now. Those are the types of things that I consider core holdings, massively diversified, right? And if you look at that, at least from this is our 100% equity portfolio. Roughly three quarters is in that diversified segment. The rest are in what we call these targets. So for right now, we have four targets, 6% each, right? We're using ETFs as far as that goes, but those are the ones that we will rotate more often. I don't really go out into the AI arena because it's too crazy. We're seeing some movement in semiconductors, and we do have some of that right now with the SOXX, the semiconductor index ETF. Although we may rotate out of that here temporarily to get more defensive, but nonetheless, that's exactly what we're doing there, is just trying to go with the flow to a certain degree with those. But this is our base model.
Yeah, so let's say I want to get into AI. Would you maybe split it? So one of the targets would be the AI target, and maybe I do half of it into an ETF, and then the other half I do um, individual stocks. So maybe I pick three stocks for 1% each.
Yes, that would be perfect. From a retail investor standpoint, that works, right? For your own account, for us, when we're managing these big accounts, we have what 800, 900, 1,000 accounts. I've lost track, right? And so we have all different sizes. And so one of the problems we have with that scenario is just if I have a 1% slice, which you could do on your own, I might not be able to get everybody into that because they don't have enough money in that particular account to buy one share. So, but yes, exactly. So you can slice and dice, those targets as far as that goes. Especially knowing that, hey, I've got a great diversification in the rest of the portfolio, and I'm just trying to kind of go after a few different areas that I think are interesting that might outperform the market in those targets. And in this case, it's limited to 24% of the portfolio, right?
Yeah, and for a home run investment, you don't need to make a big investment to have it return quite well.
Yeah, exactly. I mean, I've got some great stories with, mid 90s, 14,000 into Apple that's worth, what, 2.5, 3 million now. Different things that we've seen within the practice that clients have done. If you have a true home run, and they're rare and most likely going to have way more strikeouts, but once you get one and you let it run, it doesn't take a lot of dollars.
Yeah.
Yeah, I mean, 1% into something that is exactly right. We had a client buy a small amount of Tesla, and even though it came down a lot, and although it's had a heck of a run this year,
Yeah.
that's been a nice piece, right? That's worked out really well, but it was started off with a pretty small dollar amount. If it disappeared, it would be like, okay, it's the way it works. So, yeah, I think that's important. I do meet with some people, especially younger people, especially during the 2020, run up, where they were doing the entire portfolio was in the craziest things I've ever heard of. And a lot of them are no longer actually doing investing because it's so hard. it's just like in baseball, right? I don't know the exact stats, but the biggest home run hitters tend to be some of the higher strikeout guys too, right? And so again, that's okay on small portions of your portfolio, but do you want to strike out over and over again on your entire portfolio? It depends on your age, maybe, and your outlook. But again, that's just a personal opinion. It's just kind of how we manage money, a little bit more conservatively as far as that goes. So, but that's a good question.